how to use term life insurance to build wealth. Well, let's just get to the fast answer. You don't. It absolutely will not work. It doesn't work. I mean, only if you stage your death within a very certain period of time. So let's get to what does work and blow that completely out of the water. So let's talk about what works. What is the right amount of life insurance and what kind that we're really going to get you into to build wealth? Because there's very specific kind that you can have. The next thing we're going to talk about are the strategies to maximize your life insurance benefits. So many people get life insurance, but they don't dig into the policy. They don't loan against it. They don't even know how to really use it for the full benefit. And then the last thing I want to talk about are the common mistakes that people use when they're in term. Now, some of your term policies can actually convert to whole life. So we'll talk about that. To have this conversation, I'm bringing my expert partner, Jason, to our call. We're going to have a conversation about those 3 topics and fill you in on why how we do life insurance is the answer to building wealth. So welcome, Jason. So Jason, welcome to our interview.
Glad to be here.
Well, and I'm sure you want to comment like I did on the actual title of video, which is how to use term life insurance to build wealth. So I already burst the bubble and said, you don't. So, but I want your perspective before we even get into the actual topics. Why is term just not a tool to build wealth?
Not for your lifetime, anybody. It possibly could be for your beneficiaries, but even at that, how they're designed and what's available to you, you cannot leave your beneficiaries wealthy, right? All you're doing is replacing your human life value. And that human life value is simply calculated on how much you make and your age, right? They're simply replacing something. They're not making you wealthy. So when I first saw the title, I was like, yeah, right. No, it doesn't happen. It's not a wealth building tool. It's simply replacing a loss. Kind of like car insurance, right? You have accident insurance and you go out and you get in a collision. They're not going to buy you a BMW when you had a Ford Pinto. They're simply going to replace what was there. And so whatever lifestyle you were having before, that's what you're going to have afterwards. It's just, that's the way it works. I guess I could say a little bit about the human life formula. Let's say you're a 30-year-old making $100,000. It's about 30 times your annual income. So you should be insured for about $3 million. Again, we're talking death benefit there, right? You need to understand that true life insurance has 3 aspects to it. It is a death benefit, it's a deferred asset, and it's a current asset. Term insurance only fulfills one of those. It's not doing anything for you in your lifetime. We believe at Insurity Systems that you should be the first beneficiary of your life insurance policy.
Absolutely. How do you determine how much? Right. And I want you to talk to a range because, we're huge fans of younger adults or even kids getting policies, which most people don't even consider that. And so what's the range depending on age and how you decide on an amount?
The most that an insurance company will insure you for a death benefit simply has to do with your age and your income. It doesn't matter about your gender. It doesn't matter color of your skin, your background, anything. It's simply a multiplier. So someone between the ages of about 25 and 40, it's about 30 times your annual income. From 41 to 50, it's, 15 times. And as you get older and older, you get down to about 10 times your annual income. For the fact that all they're doing is replacing you in the event you were to pass away so that your family would have enough money, the same kind of money coming to you or coming to them rather until age 65. So they would still need to be living on that amount of money, putting away money to enjoy life after you would have turned age 65. There's no real magic to it. That's simply how much the life insurance industry calculates that your life is worth.
What are the strategies to maximize proper life insurance? So we'll go ahead and talk about whole life insurance and talk about what we are massive fans of and endorse.
Right. And so the other 2, right? The deferred asset and the current asset is what we really need to have. We need to have all 3, that trifecta. You don't have that, you really don't have much. It's going to collapse. It's going to have problems. That's one of the reasons why a UL, for example, does not work. Let's say you and I are sitting in an airplane in San Francisco and we're going to Tokyo. It's loaded. There's a bunch of people on there, a bunch of luggage, and a whole bunch of fuel. And that pilot puts a throttle all the way as fast as he can to get down the runway to slowly start getting up in the air. Well, that plane is kind of going slow at first. The reality is, though, the closer it gets to Tokyo, that plane actually starts to fly faster for the fact that there's been so much fuel burnt up, but the thrust coming out of the engines is exactly the same as when it was when it took off. So it's flying faster and faster and faster as it gets to Tokyo. The same thing happens with the proper whole life insurance that's designed for cash value, specially designed. I mean, you need the right kind of agent to do that. It accumulates cash more efficiently the longer it's in force. That's why the wealthy, the Rockefellers, the Hiltons, the Hendersons, the Langmeyers, they get policies on their kids. Now, there's a different thing is when it's a minor child, it's not income times age. It's how much the parents have. So let's say the parents have $40 million each, you can actually insure the child for close to $20 million. And then that would grow massively over their lifetime. It's going to be in force for 70, 80, 90 years. Those things grow huge, right? That's why you want it. The longer it's in force, the better it is. Because again, getting to Tokyo is kind of like at death. Everybody's going to die. That plane's eventually going to land, but towards the end, it's flying faster and faster and faster. And that's what you want. Every single person, Loral, that I've talked to, one of the things they tell me is, I wished I would have known about this blank years ago, fill in the blank, 20 years ago, 30 years ago, 40 years ago, it doesn't matter. When they really understand the long-term benefits of these, it blows them away.
I love it. So those of you out there that are finding this all interesting, I have many, many topics all around money and business finance growth. So subscribe to my channel. Make sure you're here 5 days a week. Click that notification button. Share it with 5 or 10 other people, and make sure other people in your life are very aware that there is actually a knowledge-based YouTube channel out here ready to support you and give you the compilation of what I call the bathroom wall the internet puts out there, which is a smattering of interesting facts, and you still don't know if you're right. So as we talk more about life insurance, specifically whole life, talk about the common mistakes to avoid when you're actually in that life insurance planning. And the obvious one is the title of our video, Do Not Get Term. Although that's what you're going to be marketed and that's what you're going to be pitched. And again, in the description below, we have a report that I'll have Jason talk about as well. So talk about the mistakes and how the report will help you start seeing, even though you're marketed heavily to go term, why you don't do that, which is the number one mistake.
Well, let's be clear here. The number one most profitable product for the insurance company is term insurance. Therefore, they will be marketing that the most, right? For profit for the company. The company is in business to make money, period. The problem with, and everybody's heard the mantra, buy term and invest the rest. The problem is very few people actually invest the difference effectively, and it rarely works out. I mean, there's such a small possibility of it working out the way you think. How many people do you know, Loral, that's in retirement time or passive income time that have the amount of money that they planned on, or that, the financial planner said? Most people have way less, maybe even less than 50% of what they thought it was going to have. There's another thing that when you're investing the rest in the stock market or different places, it's called a sequence of returns. If you look back last 15 years and say, okay, well, the market went up, when the market went up, market went up. Well, guess what? If the market goes down 30 or 40% in 1 year, which it has.
Oh, yeah.
And that's the very last year that you plan on before retirement. Instead of $1 million, you got 600,000. Now, in order to make that up, that could be several years of, 15% per year without another down year. That sequence of returns is massive, and it's something that people don't think about. With insurance, whole life insurance that has those 3 characteristics I told you about, you have guaranteed growth every single year. And that slow incremental growth over time, that drip, 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 is massive, right? And part of that, it takes a long-term thinking. It's not, okay, here's my $10, give me a hamburger. That's our society. And some people think that way. When you really think long-term, these policies, there isn't a better financial product on the planet. And I'll stand behind that. It's basically whole life insurance against the rest of the financial industry, in my opinion.
I know.
You also have to make sure, one of the mistakes that people are that they get the wrong product, if your term is one of them. They also don't necessarily have the policy designed for cash accumulation. There's a playoff, death benefit and cash value, right? The lower the death benefit, the higher the cash value. Well, there's another thing too. Commission to the agent, cash value.
Yeah.
Right? It's almost on the same teeter-totter. If you lower the commission to the agent, there's more cash value in the policy for you. You want to find the right kind of agent that will actually build a policy for you and then show you how to use those cash values to build wealth, which the big table is all about. That's what we're all about. And I invite everybody, come and find out more about it. Go to insuritysystems.com and get our free report. Our report is awesome. It talks about why you want to have lots of insurance. Like Loral said, in the back of that, there's a link where you can schedule some time with me. It's a no cost to you, no investment. However, I'm telling you, we can change your life.
You will. Jason, I appreciate you being here, and all of you. Take advantage of the report that's in the description below. If you have any questions, go to Ask Loral, AskLoral. Ask questions, make requests, and we will be putting together a playlist of all insurance-related topics, so you can actually just see Jason and all the years we've been doing this together and get on his calendar, which you got to get his link through the report. So go grab that first. You guys have a great day. We'll be back tomorrow.